Introduction to Interest-Only Loans. Presented by Doug Bainbridge. What does an interest-only loan do? An interest-only loan can help make the initial period of a loan more affordable for a borrower by requiring that only the interest be paid for an initial period of the loan. As we can see below, the loan amount does not start getting paid down until a little period of time has passed. And then we see it curve down, much as I displayed in a previous video showing the introduction to amortization. Assumptions. Principal, in this example, will be set at $100,000. The interest rate throughout this loan will be 4% per year. The loan will be amortized for 30 years. Interest-only payments will be for the first 5 years only. Years 6 through 30 payments will include principal and interest to pay off the loan in the 30-year period. Please do not forget that this is only an introduction to the subject, and there are many other scenarios to consider. Now, I will calculate the monthly payments. For the first 5 years of this loan, the interest payment and total payment per month will equal $333.33. For years 6 through 30, the monthly principal and interest payment equals $527.84. Therefore, the payment increases 58.4%. Consider that to do a fixed-rate loan with the same principal and interest rate as with this example, but where principal and interest is paid monthly for the life of the loan, the payment is then at $477.42. Interest-only loans, the bigger picture. Below is a graph representing our example, where the blue line represents the monthly payment, showing how there's that interest payment only period at first where you're only paying interest, and then it shoots up to including interest plus the principal, and then that is the payment for the remainder of the loan from years 6 through 30. We'll notice with the white line where the principal is not even touched for the first period while you're paying only interest, and then it starts to increase as a portion of each payment from year 6 through year 30. And the red line shows the interest, where at first it's a straight line, flat line, and then it starts to curve down as we slowly but surely pay off the principal. Conclusion. Interest-only loans can help a borrower purchase a home for less at first, as all that is required is to only pay interest at first. The important potential issue to consider is when the payments change to including principal and interest. It is important that the borrower is confident that the new higher payment is affordable. I hope you found this helpful. And again, this is presented by Doug Bainbridge.